Hello and welcome to your Forex education. Due to the fact that for the last 2 days you didn't get a video, I will give you a triple dose today to make up for it. We're going to traverse the valleys and hills of pattern land as we discuss the pattern of the double top. In technical analysis, a double top is a reversal pattern that typically occurs after an uptrend and signals a potential trend reversal to the downside. It is considered a bearish reversal pattern and is characterized by two peaks at approximately the same price level, separated by a trough or a pullback in between. I will give you a breakdown of the key features and the implications of the double top pattern. At the beginning, there is the formation. The first peak, also you can say the left shoulder, is where the price reaches a high point and begins to pull back. After the first peak, the price experiences a temporary decline, forming a trough or neckline. The price rallies again, but fails to surpass the previous peak, creating a second top around the same price level as the first peak. You could also say the second peak is the right shoulder. Typically, the trading volume diminishes during the formation of the pattern, signaling a lack of strong buying interest. The necktie line is formed by connecting of the lows of the trough, and they act as a support level. Hello and welcome to your Forex education. Due to the fact that I didn't get a video up to you for the last 2 days, I will mitigate that by giving you a triple dose today. The first dose is another traversal through the hills and valleys of pattern land as we discuss the double top. In technical analysis, a double top is a reversal pattern that typically occurs after an uptrend and signals a potential trend reversal to the downside. It is considered a bearish reversal pattern and is characterized by two peaks at approximately the same price level, separated by a trough or a pullback in between. I will now give you a brief breakdown of the key features and implications of this pattern. Let's start with the formation. The price reaches a high point and begins to pull back at the first peak. After this, the price experiences a temporary decline, forming a trough or a neckline. The price rallies again for the second peak, but fails to surpass the previous, creating a second top around the same price level as the first peak. For the volume, I can say typically trading volume diminishes during the formation of this pattern, signaling a lack of strong buying interest. The third aspect that is also important is the neckline break. The neckline formed by connecting the lows of the trough acts as a support level. A decisive break below the neckline is considered a confirmation of the pattern and signals a potential reversal. What is the target price? Well, what can I tell you about the target price? The distance between the neckline and the highest point of the pattern can be used to estimate a target for the potential price decline after the pattern is confirmed. The confirmation. Traders often wait for a daily closing below the neckline to confirm this pattern. It is important to note that while double tops are widely recognized, no pattern guarantees a specific outcome. Traders and analysts often use additional technical indicators such as momentum oscillators or volume analysis to confirm signals and make more informed decisions. Now to the neighbor of the double top, the double bottom. A double bottom is a reversal pattern in technical analysis that forms after a downtrend and signals a potential reversal to the upside. It is considered a bullish reversal pattern. It is characterized by two troughs at approximately the same price level, separated by a peak or a rally in between. Here's a little breakdown of the key features of the double bottom pattern. In the first trough, the price reaches a low point and begins to bounce back. After this trough, the price experiences a rally, forming a peak or a neckline. The price declines again, but fails to break below the previous trough, creating a second bottom around the same price level as the first trough. Similar to the double top pattern, trading volume often diminishes during the formation of the double bottom, indicating a lack of strong selling interest. The neckline, formed by connecting the highs of the peak, acts as a resistance level. A decisive break above the neckline is considered a confirmation of the pattern and signals a potential trend reversal to the upside. The distance between the neckline and the lowest point of the pattern can be used to estimate a target for the potential price advance after the pattern is confirmed. Traders often wait for a daily closing above the neckline to confirm the pattern, as with the double top. On our traversal through pattern land, we now come to a really big house. Inside the house there lives a guy who is quite complicated. This guy is called Cypher. Let's chat about it. The Cypher pattern is a specific harmonic chart pattern used in technical analysis, primarily in the field of harmonic trading. It was introduced by Scott Kine, who has written extensively on harmonic patterns. The Cypher pattern is a reversal pattern that aims to identify potential turning points in the market. Here are the key characteristics of this pattern. The structure. The Cypher pattern consists of 4 distinct legs, marked XA, AB, BC, and CD. This pattern has a real good relationship with Fibonacci. The legs of the Cypher pattern are typically associated with specific Fibonacci retracement and extension levels. The BC leg typically retraces 61.8% of the AB leg. The CD leg often completes at the 78.6% Fibonacci retracement level of the XA leg. What does that require? The BC leg should not exceed the 1.414 Fibonacci extension of the AB leg. The CD leg should complete near the 1.272 Fibonacci extension of the XA leg. Point D is the potential reversal point. Reversal point or reversal zones. Let's talk about zones. Traders often look for potential reversal zones around the completion of the CD leg, so the last one. This could be a confluence of Fibonacci levels, support, resistance zones, or other technical indicators. Let's strategize with trading this. Traders using the Cypher pattern may look for a long trade opportunity at the potential reversal zone identified by the completion of the CD leg. Stop loss orders are typically placed below the X point. Profit targets may be set at Fibonacci extension levels or other technical levels. It is important to note that, like any other harmonic pattern, the effectiveness of the Cypher pattern depends on the trader's ability to correctly identify and interpret the pattern. Additionally, no trading pattern guarantees success and risk management strategies should always be employed. Now, considering double top, double bottom, and the Cypher, you should always use these patterns in conjunction with other technical analysis tools and indicators to increase the probability of successful trades. It is advisable to practice risk management and thoroughly understand the patterns before incorporating them into a trading strategy. Now we are at the end of our triple dose for this day. I hope to see you in other videos, and keep learning and succeed in whatever you do.